We take a look at a 1 year of Fiserv, please. There's the stock today. It's down 17%. They cut their sales guidance. Let's look at the 52-week chart because the stock hit a new 52-week low. Jenny owns it. Jenny's buying more. Why?
Right. So this is a stock that we originally bought 12 years ago in 2013. We paid $25 a share for it. We're up 400+%. We actually, and this is really critical to why we added more today, we actually trimmed this in February when the stock was trading at $230 a share. And the reason we trimmed it was because it had grown so much that it was a 6% position. It's trading at 23 times earnings. And we thought at 23 times earnings, it's really pricing in perfection. And perfection in that case was really high future growth rates that we thought were a little too ambitious. So here we are. They reported today. Stock's down a bunch. It's now trading at 12 times earnings. When you said they reduced sales guidance, it's to 10% from the range of 10 to 12%. They still reaffirmed earnings guidance, which is still 15 to 17%. So you can buy a stock that's trading at 12 times earnings, 15 to 17 times EPS guidance. All their businesses, Zelle, Clover, have huge growth. Clover's growing at like 30%. Zelle's growing at 19%. Has a 7% free cash flow yield. It's just kind of perfect. By the way, earnings growth next year. So I told you it's like 15 to 17% this year. 26 is supposed to be 17%. The year after that, 27 is still expected to be 15%. So yeah, that's not the huge growth that it used to be, but it's still amazing. And here's another fun fact on this. They've delivered double-digit earnings growth for 40 years straight. So you know how Steve always talks about permanent compounders? Like, this is the definition of a permanent compounder. And also, when you ask me why I don't love the market, and I say it's trading at too rich a multiple, and I think it's expecting too much growth, like this is the microcosm of that. At 23 times, it was just expecting too high growth rates than it could actually deliver. But we love it, still holding it and happy to bump it up. Okay, what do you think about Thermo Fisher, which you also own, which is going in the opposite direction today? We can take a look at that. They raised their guide. And the CFO is retiring early, but there's the stock. It's up 12 1/3% today. So Thermo's another long-term holding, not quite as long, but we've had it for 5.5 years. It's up 70%. And it is a fantastic company, fantastic management, fantastic businesses. But what they do is like medical device testing, all of that. With all of the budget cuts and the cuts from the NIH and the cuts to universities, this has too much ambiguity for us to add to it now. And we actually did a really deep dive on it last week, thinking is now the time to add? Should we bump the position up? And there's just too much kind of political uncertainty out there for us to want to increase Thermo. So we're comfortable holding, but we don't want it to be a bigger position than it is right now.